Hey guys, welcome back to the channel. In this video, I'll be analyzing WP Carey stock, ticker symbol WPC. They're a REIT, or a real estate investment trust, that many investors like to compare to one of my current real estate holdings, Realty Income Corp. I'll be speaking about their business model, investment strategy, operating metrics, and performing a brief comparative analysis between WP Carey and Realty Income Corp. At the end of the video, I'll be giving WP Carey a rating between 1 and 10 from the perspective of a dividend investor, so make sure you stick around to the end of the video to see that. In my last video on a REIT, Realty Income Corp, you guys killed it with the like button, and we got 21 likes in the first 24 hours of that video being up. So in this video, if we can try to beat that number, that'd be incredible. I've gone ahead and made a separate video specifically dedicated to REIT analysis, because they seem to be the videos that you guys enjoy the most. So you can check that out after this video. And as you guys can now see on screen, the channel is getting close to 500 subscribers. Now only 12% of the people who watch my videos are currently subscribed to the channel. So if you're part of that 88% and you haven't yet subscribed, and you enjoy the content that I put out for you, make sure you hit the subscribe button because it really does help out the channel. And with that said, let's jump into the video. As always guys, please do your own research into these companies before you make any decisions. I'm not a registered investment advisor, and anything I say in these videos is from my own personal research and experience. The goal of the video is to give you an overview of the stock and to educate you, not tell you which stocks to buy. WP Carey is a real estate investment trust who serves a diversified tenant base through the utilization of triple net leases. This means that the tenant, on top of their base rent, is required to pay for property taxes, the insurance, and the maintenance on the property. On the screen now, you can see a very broad infographic depicting the business structure of WP Carey, but for the purposes of this analysis, I'll be focusing strictly on their real estate portfolio because it's the most important value driver for investors in my opinion. They currently own over 1,200 properties that generate over $1.1 billion in annual base rent, or ABR. Not only are they set up good now in 2020, but the company's WALT, or their weighted average lease term, is over 10 years long. So they have these tenants locked up, assuming that they don't break their lease contract for an average length of over 10 years. The majority of their properties are utilized in the industrial, warehouse, office, retail, and self-storage industries, which shows their diversified nature along with their geographical diversity, since they have properties throughout the United States and in Europe. Their tenant base is strong with 352 tenants total, and the top 10 tenants only make up 21.7% of their ABR, which means that WP Carey is not dependent on a couple super large companies for the business, so they can have a little more leverage when negotiating. Also, almost all of these leases have contractual rent increases, with 62% tied to the Consumer Pricing Index, or CPI, so they are shielded from inflationary pressures very well. And this brings us to one of the most important metrics for real estate holding companies, their occupancy rate. On screen now, you can see WP Carey's historical occupancy rate for the last 12 years. Their occupancy rate never dropped below 96%. Even during the Great Recession period, which is an incredible feat. And right now, they have an occupancy rate at just about 99%, which is crazy. But even crazier is in 2017, they had an occupancy rate of 99.8%, which is almost unheard of for real estate companies. For some context, one of the world's largest REITs, Simon Property Groups, which I do hold in my portfolio, has an occupancy rate of around 95%, and this is considered fairly normal for real estate holding companies. Now, a large criticism of WP Carey's portfolio is that their tenant quality is not nearly as high as their competitors like Realty Income Corp. Now, while this is true, I think the company has a good, if not very reasonable rationale for doing this, and here's a part of an interview that their CEO gave at the NAREIT 2019 Investor Conference.
So unlike some of your peers, WP Carey's focus is not limited to investment-grade tenants. What do you see as the advantages of that approach?
Yeah, when you think in net lease investing, many of the companies do focus on the investment-grade space. It's become quite crowded. It's where there's been the most capital inflows. It's also where there's been the most yield compression. We instead focus on the just below investment grade credit space. We think that's the sweet spot in net lease investing, where our credit expertise, underwriting, and structuring really can provide us with the best risk return. We've also looked at our portfolio and have done some default studies over the years. And what we found is that our defaults are roughly in line with the WB portfolio, perhaps even a little bit better. But where we've excelled is on the recoveries because of our credit picking, the structuring, buying critical operating assets. Our recoveries have been significantly higher. So our credit losses are much more in line with an investment grade portfolio, call it triple B, maybe even triple B plus. So the bottom line is that we may be focused on sub-investment grade, we can earn those type of yields, but the actual risks we're taking is more in line with an investment grade portfolio.
Great. Jason, thank you so much for coming.
You're welcome.
Now, I'm not going to lie. When I started researching this company around the same time that I became very interested in Realty Income Corp, the tenant quality really stuck out to me as a negative factor for WP Carey. However, I do like the way that their CEO explained it here, and I agree with it for the most part. I don't think I'm quite able to agree with his statement that their tenants carry about the same amount of risk as investment-grade tenants, but I can get on board with the main point. Sub-investment-grade tenants probably do offer a better risk-adjusted rate of return on their investment. And on screen now, you can see the 10 largest tenants for WP Carey, and for the most part, these aren't really super risky tenants. At least for the businesses I'm familiar with, U-Haul, Extra Space Storage, and Advanced Auto Parts, these are all really well established and in my opinion, pretty safe tenants. The only one on the list that I'm somewhat questioning their safety is Marriott, because nobody really understands the full impact that this pandemic situation will have on the hospitality industry in the long term. Not only do they have a low tenant concentration, they also have tenants from many different industries which occupy many different types of buildings. On screen now, you can see the breakdown of WP Carey's building type and tenant industry. But for now, let's just focus on the diversification that their tenants have in the industries that they work in. By far the largest industry concentration is retail, but even then, it only makes up 22% of their ABR. From there, they have 9% of their rent coming from consumer services companies, 7% automotive companies, and then every other industry accounts for 5% or less of their ABR. This means that the company is somewhat insulated from industry-specific issues, and thus, the investment carries a little bit less risk. So with all that said, let's compare WP Carey to another REIT that I did an analysis on in the last month, Realty Income Corp, ticker symbol O. However, I just want everyone to know that this short comparison will not go into any details, but will highlight a couple of key differences between these companies. So starting with the reason why investors love these companies, the dividend payments. Historically, WP Carey has had a significantly higher dividend payment than Realty Income Corp, and this definitely is still true with WP Carey yielding just about 6% at current prices, and Realty Income Corp yielding 4.5%. Also, as a disclaimer, for this analysis, I was using Seeking Alpha for these metrics, but I think they got WP Carey's dividend growth period wrong because of an irregular payment made in 2013. So, I looked at their dividend history myself and came up with my own figure of 20 years. So WP Carey has been increasing their dividend payments for 20 straight years, and Realty Income Corp for 26 years. And this does have WP Carey losing out, but really this isn't a huge factor, because in my mind, every additional year means a little less than the last year. So, when we look at these long time periods, like anything 20 years plus, a couple of years here or there doesn't really make a large difference in my mind. However, when we do look at debt to equity for the two companies, Realty Income Corp does come out ahead by a pretty large margin. What this means for an investor is that Realty Income Corp is a little less risky, in the sense that they have less debt on their properties, and if their tenants stop paying, they have a little less debt to service on those missed payments. But on the other side, WP Carey has a little higher upside potential for their invested capital, assuming that their cost of capital for debt is lower than the cost of capital for equity, which was usually the case for these companies. I'm not going to go into detail in this video about what all of that means specifically, because it can become a fairly complicated subject. But it does mean that WP Carey has more risk, but it also could have higher rewards. For their tenant concentration, WP Carey comes out a little ahead of Realty Income Corp, so their tenants have a little less leverage when negotiating their contracts, which means WP Carey is probably getting marginally better rates on these properties. It also means that if one of their largest customer leaves, it will have a smaller effect on WP Carey than it would if Realty Income Corp's largest customer would leave. Thus, this lowers the risk for WP Carey when compared to Realty Income Corp. And we've already talked about the merits of investment-grade tenants when we watched the video from WP Carey's CEO, but this just highlights that they are operating in slightly different markets. So I would say that if you only have one REIT in your portfolio, and you want it to be a very safe company, Realty Income Corp is probably a little bit better for that investor. But if you have a couple REIT positions and you want a higher dividend yield, I would say WP Carey is a better option. It really just depends on the goals of the specific investor. And to summarize my position on WP Carey overall, I would say that they're a very interesting investment. The way that they've strategically placed themselves out of a super competitive area could pay off for them in the future. On a scale from 1 to 10, from the perspective of a dividend-focused investor, I would give WP Carey a solid 9 due to their high dividend yield, diversified business model, and their ability to maintain super high occupancy rates through good and bad economic environments. And if you guys enjoyed this video, make sure to only click the like button one time, because if you hit it twice, it takes away that first like, so we don't want that. Please subscribe to the channel and turn on notifications so you don't miss future uploads. On the screen in a few seconds, there will be a couple videos chosen just for you, so watch one of those, and I will see you guys in the next video.